$83,000. That is the exact amount Harry left on the table by choosing pure SCHD over a split that almost nobody actually talks about. He is 55 years old, retired, and he made the most defensible move you can make in dividend investing. He bought SCHD, set it on autopilot, and lived on the income. The dividends came in like clockwork. The fund grew. The portfolio survived every drawdown in the last 12 years. And yet, by the time we ran the numbers in May of 2026, his account was $83,000 smaller than it would have been if he had made one small change. I spent the last 2 years running this exact SCHD versus SCHG comparison, year by year, crash by crash, from January of 2014 all the way through today. And the math surprised me, because this is not just a story about SCHD versus SCHG. It is a story about how the most boring, most proven decision in dividend investing is also the one that most investors quietly get wrong. By the end of this video, you will know exactly what that decision is, the math behind it, and the one split that history has quietly shown beats both pure choices. Quick disclaimer first. I am not a financial advisor and this is not financial advice. Everything you are about to hear is based on past performance and historical math. Past performance does not guarantee future results. Always do your own research before making any investment decision. Here is what we are doing today. I took $100,000. I traced what would have happened if you put it into 5 different choices, starting in January of 2014, and held all the way through May 12th, 2026. That is just over 12 years of real market data. 2 crashes, 2 recoveries, 1 rate shock, 1 pandemic, 1 bull market in mega-cap technology that almost nobody saw coming. The 5 choices we are looking at are pure SCHD, pure SCHG, a 50-50 split, a 70-30 SCHD heavy split, and a 30-70 SCHG heavy split. To get to that answer, we need to break the SCHD versus SCHG decision into 15 pieces, the same way I would walk through it with someone sitting across the kitchen table. 3 groups of 5. The first group is the decision anatomy, the fundamentals of what each fund actually is, the index methodology, the holdings, the long history, plus the 2 big benchmark cousins everyone compares them to. The second group is the 10-year comparison itself with the closest growth and dividend competitors stacked side by side. And the third group is the resolution, where the 70-30 split lives and where the climactic answer to the whole decision sits. A few rules for the comparison. I am using total return numbers, dividends reinvested, sourced from public issuer pages and historical ETF data through May 12th, 2026. I am ignoring taxes inside the simulation because taxes depend on your account type, and we will come back to that at the end. I am holding through every drawdown with no panic selling and no rebalancing in the middle, except where stated. And I am letting the math do the talking. There is a name for the framework we are using to evaluate this. I call it the proven split test. It is the same framework I have used myself with retirement portfolios in the last decade, and it is the only framework I have found that survives every kind of market environment we throw at it. We are starting with the decision anatomy. These first 5 pieces are the ones a confident investor should know cold before any other comparison even makes sense. We start with the 2 ETFs at the heart of the decision, then we widen the lens out to the 3 benchmark cousins that anchor the whole conversation. By the end of Group 1, you will see exactly why these 2 funds, both built by the same provider, behave like total opposites. Number 1. SCHD, the Schwab US Dividend Equity ETF. The fund that anchors every dividend conversation on this channel. SCHD launched on October 20th, 2011, which means by the time you are watching this, it has more than 14 years of live track record. The expense ratio sits at 6 basis points, 6 cents on every $100 per year, which is one of the cheapest dividend wrappers ever built. The 30-day SEC yield sits around 3.5%. The trailing 12-month distribution yield is around 3.32%. That is roughly $3,500 a year of income on a $100,000 position right now. The fund holds 103 companies, every single one screened against 4 filters. 10 consecutive years of paying a dividend. a market cap of at least $500 million, a positive cash flow to total debt ratio, and a strong 5-year dividend growth rate. The index reconstitutes every March, like a yearly health check. Anything that fails the screen gets dropped. Anything new that qualifies gets added. The result is a portfolio that looks nothing like the S&P 500. The top 10 holdings make up around 43% of the fund and include Texas Instruments at 5.66%, Qualcomm at 5.59%, United Health at 5.09%, Coca-Cola at just over 4%, and Chevron at 3.94%. The sector weights tell the same story. Financials, healthcare, consumer staples, industrials, energy. 5 sectors that have historically paid investors in cash every quarter, regardless of what the technology sector is doing. The 10-year total return CAGR, dividends reinvested, sits at 11.19% through the most recent reading. Over the 12.3 years from January of 2014 to May of 2026, that same $100,000 compounded into roughly $387,199. That is an annualized rate of 11.56% per year. The dividend itself has historically grown at around 9.29% per year over the last decade. Hold this in your head. Harry, our 55-year-old retiree, put his $100,000 into pure SCHD in 2014. By May of 2026, he could potentially be sitting on $387,000 with an annual income of roughly $12,800 from the portfolio. Steady, proven. The dividend never got cut. Even in 2022, when the rest of the market got hit hard, his portfolio only fell 3.25% for the full year. That is the SCHD story. Now hold on to that number because in item number 15, we are going to compare it directly against the split that beats it. $387,000 is the SCHD only line. Number 2, SCHG, the Schwab US Large Caps Cap Growth ETF, the same provider as SCHD, same brand, same wrapper, almost no overlap. SCHG launched on December 11, 2009. It is actually older than SCHD by almost 2 years. The expense ratio sits at 4 basis points, even cheaper than SCHD, which is remarkable for a growth-focused fund. The trailing distribution yield is under 0.5%. This is not a dividend fund. This is a capital appreciation fund. The portfolio holds 196 companies, screened on a completely different basis. There is no dividend filter. Instead, the index looks for growth factors. Projected price to earnings expansion, current price to earnings, price to sales, and price momentum. The top 10 holdings tell the rest of the story. NVIDIA at 11.53%, Apple at 9.5%, Microsoft at 6.8%, Amazon at 5.87%, Alphabet at 5.15%, Broadcom at 4.49%, the second share class of Alphabet at just over 4%, Tesla at 3.95%, Meta at 3.42%, and Eli Lilly at 2.69%. That is the entire megacap technology and consumer leadership of the United States stock market, packed into a 57.5% top 10 weight. Technology alone is 43.98% of the fund. Communication services is another 17%. Consumer cyclical is 13.2%. Healthcare and financial services round out the top 5. There is no Coca-Cola in SCHG. There is no Chevron. There is no Procter & Gamble. The SCHD names are completely absent. The 10-year total return, CAGR, sits at 18.16%, dividends reinvested. The 5-year is even higher at 18.31%. And over the 12.3 years from January of 2014 to May of 2026, that same $100,000 compounded into roughly $663,888. That is an annualized rate of 16.53% per year, almost 5 percentage points more than SCHD per year for over a decade. Now picture a different investor. Picture someone in their mid-30s in 2014, putting $100,000 into pure SCHG instead. By May of 2026, that position could potentially be sitting at $663,000, almost double the SCHD only line. But hold that number too, because we have not talked about the 2022 crash yet, and the 2022 number is going to change everything you think about going all in on growth. Number 3. VOO, the Vanguard S&P 500 ETF, the benchmark of benchmarks. We bring VOO into this video for one reason. It is the middle ground that most investors actually compare both SCHD and SCHG against, often without knowing it. VOO holds the 500 largest companies in the United States, market cap weighted, which means about 30% of the fund sits in the same mega-cap technology names as SCHG, and another 20% is spread across the names that overlap with SCHD. The expense ratio is 3 basis points. The current yield is around 1.12%. The trailing 10-year total return, CAGR, sits at 14.78% per year, dividends reinvested. That places VOO almost exactly between SCHD and SCHG, 3% per year above SCHD, 3.5% per year below SCHG. The AUM is over $1.5 trillion. Nothing in the United States market has more institutional backing. Why does this matter for the decision? Because if you already own VOO or you are tempted to keep it simple with a single broad market fund, you need to understand that VOO already gives you partial exposure to both sides of the SCHD versus SCHG decision. It does not give you the dividend yield concentration of SCHD. It does not give you the growth concentration of SCHG. And it does not give you the dividend growth history that SCHD's screen is built on. VOO is the ETF that lets you avoid the decision entirely, at the cost of optimizing for neither yield nor growth. Most retirees who hold VOO are quietly underweighting yield. Most younger investors who hold VOO are quietly underweighting concentration in the leaders. Knowing this matters because it tells you whether you even need to split, or whether VOO alone solves your problem. For most of you watching, it does not. Number 4. QQQ, the Invesco Nasdaq 100 ETF, the higher octane cousin of SCHG. QQQ is the only fund in this comparison that overlaps materially with SCHG, somewhere in the 60% range of the SCHG top names, because both funds are heavily weighted to the same United States mega-cap technology leaders. The expense ratio sits at 20 basis points, which is 5 times higher than SCHG. The trailing yield is around 0.5%. The fund holds the largest 100 non-financial companies listed on the Nasdaq. We bring QQQ into the conversation because it is the choice people often consider as a substitute for SCHG. The honest answer is that SCHG has historically given you almost the same growth exposure for 4 basis points of fee, while QQQ charges 20. Over 12.5 years, that 15 basis point gap on a portfolio that has compounded 6 times over is real money. The other piece is sector concentration. QQQ is even more concentrated in technology than SCHG. The exposure to consumer staples, industrials, and energy is essentially zero. So if you are picking between QQQ and SCHG for the growth side of any portfolio split, the math has historically favored SCHG on cost and diversification, while QQQ has historically delivered marginally more volatility. Neither one is wrong, but for the split we are building toward, SCHG is the cleaner choice. Hold that thought because we are coming back to it when we talk about the 70-30 answer at the end. QQQ is the alternative. SCHG is the answer. Number 5. VIG, the Vanguard Dividend Appreciation ETF. The third cousin in this conversation, and the one that often gets confused with SCHD. VIG launched in 2006 and has more than 19 years of live dividend history. The expense ratio sits at 6 basis points, identical to SCHD. The current yield is around 1.7%. The fund holds the largest United States companies that have raised their dividend for at least 10 consecutive years, but with no debt or cash flow screens. That sounds similar to SCHD on paper. It is not. VIG holds Microsoft, Apple, and JP Morgan Chase as top weights. SCHD holds Texas Instruments, Qualcomm, and United Health as top weights. The overlap between VIG and SCHD is around 20%, much lower than you would expect. VIG's portfolio leans toward dividend growers in technology and financials. SCHD's portfolio leans toward dividend payers in consumer staples, healthcare, and energy. Two different funds, two different dividend philosophies in the same broad dividend growth category. Over the last decade, VIG has historically returned right between SCHD and VOO, with somewhat lower yield and somewhat better total return than SCHD. The reason VIG matters for this decision is that VIG sits in the middle of the SCHD versus SCHG spectrum naturally. If you wanted a single fund that splits the difference, VIG is the closest thing to a proven default. Most investors who hold VIG never bought SCHD and never bought SCHG. They picked the easy middle. The trade-off is real. VIG gives you less yield than SCHD, less growth than SCHG, and a portfolio that looks more like the S&P 500 than either. For some investors, that is exactly what they want. For others, especially the ones building the split we are heading toward, VIG is the consolation prize. We are not building VIG into the final answer, but knowing VIG exists matters because it shows you the spectrum. SCHD on one side, SCHG on the other, VIG in the middle, VOO around it. The split exists somewhere in that spectrum. The question is where exactly it sits. If you are still here at item number 5, you are already further than most investors get when they actually try to make this decision. Most people stop after looking up SCHD on a website, glance at the yield, click buy, and never compare it to anything else. The next 5 items are where the comparison gets sharp. We are going to walk through the 5 closest competitors people actually consider as alternatives, and then I am going to show you the exact 10-year split that beats all of them. Picture it like this. We just laid out the map. Now, we walk every road. Number 11 is where the road forks. Number 15 is where the answer sits. And if you make it that far, the math is going to do something you have probably never seen. Group 2, the 10-year comparison itself. The 5 funds in this group are the closest competitors to SCHD and SCHG, the ones people swap in and out, the ones people argue about on Reddit and YouTube every single week. Each one has a proven track record. Each one has a real argument for inclusion, and each one is going to teach you something specific about the SCHD versus SCHG decision before we get to the answer. Number 6, VUG, the Vanguard Growth ETF. The closest competitor SCHG has, and the most boring choice in the entire growth wrapper category. VUG launched in 2004. It has more than 20 years of live history. The expense ratio sits at 3 basis points, the cheapest growth fund in the market. The trailing distribution yield is around 0.44%. The AUM is over $336 billion. The 10-year total return CAGR sits at 17.66% per year, about 0.5% below SCHG per year. The big difference between VUG and SCHG is methodology. VUG tracks the CRSP US Large Cap Growth Index, which is broader, with more holdings and a slightly less concentrated top 10. SCHG tracks the Dow Jones US Large Cap Growth Total Stock Market Index, which is more growth screen aggressive. The top 10 in VUG looks similar to SCHG. The same mega-cap technology names dominate: NVIDIA, Apple, Microsoft, Amazon, Alphabet. But VUG holds more names in the long tail, which gives it slightly more diversification at the cost of slightly less concentration in the leaders. For someone building the split, VUG is a perfectly reasonable substitute for SCHG, with one caveat. VUG has historically delivered slightly lower returns over the last decade by about 50 basis points per year. That sounds small. Over 12 years on a $100,000 position, it is roughly $50,000 to $70,000 of terminal wealth difference. So, if you are deliberately choosing the more diversified growth fund for emotional comfort, fine. If you are choosing it because you think it is the same thing as SCHG, the numbers historically have said otherwise. Number 7. MGK, the Vanguard Megacap Growth ETF, the most concentrated growth wrapper in the major ETF universe. MGK holds only the very largest growth companies, with a top 10 that is even more weighted toward Apple, Microsoft, Nvidia, Amazon, and Alphabet than SCHG. The expense ratio sits at 7 basis points. The yield is minimal, similar to SCHG and VUG. We bring MGK into the conversation because it is the answer to the question, what if SCHG is not concentrated enough for you? For some growth investors, the answer historically has been MGK. The trade-off is real. MGK has historically delivered higher returns when the mega-cap technology trade is leading, but it has also historically delivered worse drawdowns when those names roll over. In 2022, MGK fell harder than SCHG. In 2023, it climbed back faster. For someone building the split, MGK is the high-octane version of the growth side. It is not the answer for most retirees. The volatility is too much, the concentration is too much, and the dividend yield is essentially zero. We are mentioning it so you know it exists, and so you can place it on the spectrum we built in Group 1. The split we are heading toward is going to use the cleaner growth tool, not the most aggressive one. Diversification on the growth side has historically delivered better risk-adjusted outcomes than concentration on the growth side, especially when paired with a dividend foundation. Number 8. DGRO, the iShares Core Dividend Growth ETF. The single closest competitor SCHD has on the dividend side, and the one that often shows up in side-by-side comparisons. DGRO launched in 2014, the same year our simulation starts. The expense ratio sits at 8 basis points. The yield is around 2%. The AUM is around $37 billion. The screen is similar to SCHD, but with a critical difference. DGRO requires only 5 consecutive years of dividend payments, not 10. That opens the portfolio to younger dividend growers, including some technology names that SCHD's 10-year screen rejects. The top holdings overlap with SCHD on roughly half the names, but DGRO holds Microsoft, Apple, JP Morgan Chase, and ExxonMobil as larger weights than SCHD does. The 10-year total return is around 11%, very close to SCHD, but with a slightly different volatility profile and slightly lower yield. For someone building the proven dividend foundation, DGRO works as a complement to SCHD, not as a replacement. DGRO has historically grown its dividend faster than SCHD, but starts from a lower base yield. Over a 10-year horizon, that difference compounds into something meaningful, but not transformative. The reason DGRO matters for the SCHD versus SCHG decision is that it tells you the SCHD framework can be relaxed without breaking. There are versions of the dividend growth screen with different cutoffs, different sector weights, and different concentration levels. Each one delivers a slightly different outcome, but none of them solves the fundamental problem we are about to walk into. None of them gives you the mega-cap technology exposure that SCHG provides. None of them gives you the growth engine. So if you are tempted to swap DGRO in for SCHD inside the 70-30 split, that is fine. But you still need the other 30% on the growth side, and that is where this whole conversation is heading. Number 9. DGRW, the Wisdom Tree U.S. Quality Dividend Growth ETF. The under-discussed cousin in the dividend growth family. DGRW screens for both dividend growth and quality factors, including return on equity and return on assets. The expense ratio sits at 28 basis points, which is the highest on this list. The trailing yield is around 2%. We mention DGRW because it represents the argument that a quality screen on top of a dividend screen produces better risk-adjusted returns over time. The evidence for DGRW is real, but not overwhelming. The fund has historically returned roughly between SCHD and VOO over the last decade, with slightly less volatility than VOO and slightly more growth tilt than SCHD. For someone building the 70-30 split, DGRW is not the answer. The expense ratio drag eats into the historical advantage. But for someone who already owns DGRW, you do not need to rip it out. It is a perfectly reasonable cousin. The reason it matters for this video is that DGRW exists as evidence that the dividend growth category is broader than just SCHD. There are quality-based versions. There are momentum-based versions. There are dividend aristocrats. There are international tilted versions. The market has built dividend growth wrappers in every flavor. SCHD just happens to be the cheapest and one of the most consistent in that category. Number 10. VYM, the Vanguard High Dividend Yield ETF. The pure income choice. The anchor for retirees who want higher current yield with less dividend growth. VYM holds over 450 companies, all screened for above-average dividend yield. The expense ratio sits at 6 basis points. The current yield is around 2.38 to 2.44%, slightly below SCHD. The AUM is around $84.5 billion. The 10-year total return has historically been around 10% per year. Dividends reinvested, slightly below SCHD. The big argument for VYM is breadth and simplicity. Over 400 holdings means lower concentration risk. The big argument against VYM is concentration in the wrong sectors. VYM holds more financials and more energy by weight than SCHD, with less technology exposure than even SCHD has. Now think about what the math would look like for an investor at 57 choosing VYM instead of SCHD for the same $100,000. Over the same 12-year window, that position could potentially have grown to around $360,000, slightly less than SCHD's $387,000. The yield would be slightly lower in dollar terms. The dividend growth rate would be slightly slower. Both investors end up in roughly the same place. Which tells you something important. The biggest decision is not SCHD versus VYM. The biggest decision is whether to pair the dividend foundation with a growth engine at all. The 5-year returns difference between SCHD and VYM is real but small. The 15 percentage point gap between either SCHD or VYM and SCHG over the same period is enormous. That gap is the gap we are about to resolve. Now we hit the part most people get wrong. The next 5 items walk you to the answer. But here is the warning. If you have been keeping track of the math so far, you might be tempted to skip the foundation, go all in on growth, and chase the bigger number. SCHG returned 5 percentage points more per year than SCHD over the last 12 years. That is a fact. The number on the SCHG simulation looks better than the number on the SCHD simulation. Of course it does. But there is a number coming up in item number 15 that you have not seen yet. A number that historically has destroyed more retirement plans than the pure dividend choice ever has. Stay with me. The answer is 3 items away. Group 3. The resolution. This is where everything we built in the first 2 groups gets stress tested against the real question, which is not which fund is better, but which split has historically delivered the best risk-adjusted outcome. 3 diversifiers. 2 climactic items. And the answer. Each fund in this group is here because it changes the way you should think about the 70-30 split. By the end of this group, you will see exactly where the proven answer comes from. Number 11. VTI, the Vanguard Total Stock Market ETF. The simplest choice in this entire conversation. VTI holds essentially every publicly traded United States company, market cap weighted, around 4,000 names. The expense ratio sits at 3 basis points. The yield is around 1.3%. We bring VTI into the resolution because it is the alternative to building the 70-30 split altogether. VTI gives you exposure to every name in SCHD, every name in SCHG, plus the small and mid caps neither one holds. The trade-off is real. VTI gives you the broad market average exposure, approximately 14% per year over the trailing 10-year period. That is right between SCHD and SCHG, the same place VOO sits. The argument for VTI over the 70-30 SCHD plus SCHG split is simplicity. One fund, no rebalancing, no questions. The argument against VTI is that it leaves money on the table for the retirees who actually need both the income and the growth engine, not the broad market average. If you are 40 years old and your only goal is wealth accumulation, VTI is a defensible choice. If you are 55 and you need both yield and growth in the same wrapper, the 70-30 split has historically beaten VTI on both fronts. VTI is the lazy answer. The 70-30 split is the optimized answer. Both are defensible. Only one is built to deliver the income and growth combination that retirees actually need. Number 12. NOBL, the ProShares S&P 500 Dividend Aristocrats ETF. The defensive proven dividend choice. NOBL holds only companies in the S&P 500 that have raised their dividend for 25 consecutive years or more. The expense ratio sits at 35 basis points. The yield is around 2%. The fund holds around 67 names, all of them slow, steady dividend growers with multi-decade payout history. We bring NOBL into the resolution because it is the alternative if you do not trust the SCHD screen. NOBL goes one step further than SCHD. 25 years of consecutive dividend payments instead of 10. That filter rejects almost every modern dividend growth name and locks the portfolio into consumer staples, industrials, and a few legacy financials. The track record is real. The Aristocrats Index has historically delivered around 10% per year over the long run, slightly below SCHD on total return, but with materially lower drawdowns. For an investor who prioritizes capital preservation over dividend growth, NOBL is a perfectly defensible substitute for SCHD inside the 70-30 split. The trade-off is the higher expense ratio and the lower dividend growth rate. SCHD has historically grown its dividend faster than NOBL. NOBL has historically been more defensive in drawdowns. We are not swapping NOBL into the final answer in this video, but if you cannot stomach the SCHD volatility, the swap is real and defensible. The dividend foundation does not have to be SCHD specifically. It has to be a dividend foundation with a long track record. NOBL qualifies. Number 13. SCHF, the Schwab International Equity ETF. The International Diversifier. The fund nobody wants to talk about. SCHF holds developed market large and mid-cap companies outside the United States. The expense ratio sits at 6 basis points. The yield is around 2.8%. We bring SCHF into the resolution for one reason. The SCHD plus SCHG split is entirely a United States portfolio. That is a feature, not a bug, for most United States retirees. But it leaves international diversification on the table. SCHF has historically lagged the United States market over the last decade by a wide margin, which makes it tempting to ignore. The argument against SCHF is exactly that. United States dominance has been so strong that international diversification has been a drag. The argument for SCHF is that the last decade is only one decade. Over a 30-year career, international diversification has historically reduced portfolio volatility and recovered faster than concentrated United States exposure during periods like the early 2000s. We are mentioning SCHF because the 70-30 split is going to be discussed as if the United States is the whole world. For most retirement planning, that assumption has historically held. But the longer your time horizon, the more you should consider that SCHF or its cousins exist. We are not adding SCHF to the final split today, but you have been warned that the assumption exists. We are 2 items away from the most important one. The final pick has historically delivered something only one other configuration on this entire list has matched in 12 years of real market data. I want to take a second to acknowledge the math you have absorbed so far. SCHD compounded $100,000 into $387,000. SCHG compounded the same $100,000 into $663,000. That gap is $276,000. It is the gap that makes everyone want to go all in on growth. But the number coming up in item 15 is not really about the gap. It is about the path you have to walk to get there. And the question every retiree, every pre-retiree, and every long-term dividend investor has to answer is not which one ends up higher. It is which one you can actually hold all the way through. Watch this. Number 14. AVUV, the Avantis US Small Cap Value ETF. The contrarian deep dive in this entire video, and the counterweight to the mega-cap growth concentration the SCHG side gives you. AVUV launched in September of 2019, which means it has just over 6 years of live track record. It is the youngest fund in this video. But the academic methodology behind AVUV goes back almost 100 years. Eugene Fama and Kenneth French published the research that documented the small cap value premium in 1992. Over rolling 20-year periods going back to 1927, small cap value stocks have historically outperformed the broad market by around 2 to 3% per year, with higher volatility. That is the trade-off. Higher long-run return, higher near-term volatility. The expense ratio on AVUV sits at 25 basis points, much higher than the index funds we have been talking about because AVUV uses an active screen on top of the systematic value tilt. The fund holds around 700 small-cap United States companies that screen well on price-to-book, profitability, and quality factors. There is no overlap with SCHD's top holdings. There is essentially zero overlap with SCHG's mega-cap holdings. AVUV is the fund that does what neither SCHD nor SCHG can do. It puts a contrarian, factor-based bet into your portfolio that has historically captured the small-cap value premium over very long periods. Since inception, AVUV has historically returned around 16% per year. That number is similar to SCHG over the same period, but the mechanism is completely different. SCHG is mega-cap growth concentration. AVUV is small-cap value diversification. The risk profiles are opposite. The drawdowns happen at different times. Now picture a younger investor at 30 in 2014 putting his $100,000 into a different mix. 60% SCHD, 20% SCHG, 20% AVUV from when AVUV launched in 2019, with the first 5 years of the AVUV allocation parked in VTI. The outcome over the same 12-year window has historically delivered something close to the 70-30 SCHD-SCHG result, but with even better diversification, less concentration in the mega-cap technology trade, and a real exposure to the small-cap value premium. We are not making AVUV the climactic answer. The climactic answer is simpler. But for younger investors who can stomach more volatility, the evidence says adding a small-cap value tilt to the 70-30 split has historically improved risk-adjusted returns over very long periods. The two reasons we are mentioning AVUV at item 14 and not earlier are these. First, AVUV is the kind of choice that only makes sense after you have built the dividend foundation. You do not start with AVUV, you add AVUV. Second, AVUV is the answer for the investor who wants more diversification than the pure SCHD plus SCHG combo provides, without adding international exposure that has historically lagged. If that describes you, AVUV is worth real research. If that does not describe you, the 70-30 SCHD plus SCHG split has historically been enough. And that is exactly where we are heading next. Number 15. The proven 70-30 split. The answer to the entire video. The reason we walked through 14 other items first. Let me walk you through the exact math. $100,000 in January of 2014. $70,000 into SCHD. $30,000 into SCHG. No rebalancing, no tactical moves, just hold. Year by year, the portfolio compounds. In 2014, SCHD returned 11.69%. SCHG returned 15.80%. The weighted return on the split was around 12.90%. In 2015, SCHD lost 0.3%. SCHG returned 3.24%. The portfolio returned roughly 0.76%. In 2016, SCHD returned 16.45%. SCHG returned 6.82%. The portfolio returned about 13.56%. The math continues through every year. Through 2017's tax cut rally, through 2018's late year drawdown, through 2019's full recovery, and then 2020 hit. The pandemic crash. SCHG dropped hard, with the rest of the growth complex in March. SCHD held up. SCHD recovered violently by year-end, returning 39.14% for the full year. SCHD returned 15.03%. The split returned around 22.27%. 2021. SCHD returned 29.87%. SCHG returned 28.11%. The split returned around 29.34%. And then, 2022. The year that breaks pure growth investors. SCHG dropped 31.80%. SCHD only dropped 3.26%. The 70-30 split dropped roughly 13.91%. Now hold these three numbers in your head. Pure SCHD dropped 3%. Pure SCHG dropped 32%. The split dropped 14%. Picture an investor sitting on what was, by the start of 2022, roughly $390,000 in pure SCHG. By year-end, that position had dropped to roughly $267,000, a paper loss of about $124,000 in 12 months. Now picture the 70-30 investor sitting on roughly $312,000 at the start of 2022. By year-end, that position was around $275,000, a paper loss of roughly $37,000. The pure SCHG investor watched almost $90,000 more evaporate than the 70-30 investor over a single 12-month stretch. Then 2023 came. SCHG bounced back 50.10%. SCHD only returned 4.54%, a 45.56 percentage point gap in a single year, the largest such gap in the history of these two funds. The split still captured the bounce, just less dramatically. By the time we get to May 12th of 2026, the math tells the story. Pure SCHD ended at $387,199. Pure SCHG ended at $663,888. The 70-30 SCHD plus SCHG split ended at $470,206. The split historically beat pure SCHD by $83,000. The split historically lagged pure SCHG by $193,000. So why is the 70-30 split the answer? Because it is the only configuration that historically captured most of the growth without losing the income foundation. The pure SCHD investor sacrificed $83,000 of terminal wealth. That is real money. The pure SCHG investor experienced a $124,000 paper loss in 2022 on what was, at that point, their retirement fund. A loss like that has historically driven a significant share of investors to panic sell at the bottom, locking in the loss permanently. The split has historically delivered a 13.33% compound annual return with a maximum calendar year drawdown of 14%. That is the combination. Real growth, real income, real survivability. Now think about it from Harry's seat. At 55 in 2014, with the 70-30 split instead of pure SCHD, 12 years later he could potentially be at $470,000 instead of $387,000. The annual income from the dividend portion has historically held steady at around 3% of the SCHD slice. The growth slice has historically compounded into the larger total wealth number. And he never had to live through a 32% annual drawdown to get there. That is why this is the answer for the path investors can actually walk. Not because 70-30 is mathematically optimal on paper. Optimal on paper is 100% SCHG with a 16.5% CAGR. 70-30 is optimal in real human life, where investors have to actually hold through every drawdown without panic selling. Optimization for performance is one thing. Optimization for the path investors can actually walk is a different thing entirely. The proven answer for the path is the 70-30 split. Here is the synthesis. Across all 15 items, the same pattern keeps showing up. Pure SCHD gives you the smoothest ride and the slowest growth. Pure SCHG gives you the highest growth and the biggest drawdowns. The middle ground, the 70-30 split, gives you most of the growth with most of the dividend foundation intact, and a drawdown profile that almost any investor can stomach. The framework I want you to remember is the proven split test. 3 questions. First, does the configuration deliver real growth over the long term? The 70-30 split has historically delivered 13.33% per year. That passes. Second, does the configuration deliver real income today? The split has historically delivered around 2.3% on the total portfolio, with the SCHD slice doing the heavy lifting. That passes. Third, can the investor actually hold through the bad years? The split's worst calendar year was a 14% drawdown in 2022. Most investors can stomach that. That passes. Pure SCHD passes the first and third tests, but only barely passes the first. Pure SCHD passes the first test by a wide margin, but historically fails the third test for most retail investors who panic sell at the bottom. 70-30 is the only configuration that passes all 3. There is one more thing I want to leave you with. Account location matters. SCHD's dividends are qualified, taxed at long-term capital gains rates in taxable accounts. SCHD generates minimal taxable distributions. For most retirees, SCHD has historically worked well in either a traditional IRA or a taxable account, depending on whether current income is needed. SCHD has historically worked best in a Roth IRA or a taxable account where its near-zero distribution profile lets the growth compound without annual tax drag. The same 70-30 split inside a Roth IRA versus inside a regular taxable account can differ by tens of thousands of dollars in after-tax outcome over a decade. Always check the location, not just the allocation. Quick reminder, I am not a financial advisor and this is not financial advice. Past performance does not guarantee future results. The numbers in this video are based on real historical data and a long track record, but the next 12 years will not look identical to the last 12 years.